fiat currencies are backed by nothing, but they also have no limit to the number that can be printed. And so literally, a handful of individuals can get together and just decide to increase the broad money supply by 25% year over year. And all the participants that own that currency have no say in that.
This is Donegan Kaiser, founder of Liberty in Finance. I'm now a licensed gold and silver dealer with Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized, private service from one of the oldest and best respected companies in the business. 30 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded, insured delivery or vault storage or IRAs, excellent prices, privacy and confidentiality, pay by check, money order, ACH or wire, satisfaction guaranteed. Call me directly at 419-819-9209 or my associate at 310-562-6400 or email us at kaiser@milesfranklin.com. Welcome back to Liberty in Finance. We have a returning guest, Lyn Alden, a well-known analyst who speaks out on many channels about the state of our economy and financial world, is here with us again. Lyn, thanks for joining us this Friday, January 15th, 2021.
Hey, thanks for having me again.
Your past interview with us was very popular with all of our viewers, and they've, this time again, not disappointed us with submitting lots of questions ahead of your arrival here. So just wanted to thank you for having been very thought-provoking, and people were just uniformly commenting on the level of analysis that you bring to the topics that you deal with and the answers that you gave to their questions. They really appreciated that. So we wanted to kick this off with a topic which has been, I would guess I'd call it controversial. It's certainly important to people, and it certainly is important to decision makers in our financial world, and that's inflation. Does it exist or not? Is it happening or not? We've had a variety of perspectives shared by guests on that topic, some saying absolutely, if you use, John Williams from shadowstats.com talks about if you use the same methods of tracking the consumer price index, et cetera, as that were used originally, and don't do a bunch of substitutions and things like that, then you see a much higher number, like somewhere around the 6 to 10% range for inflation, as opposed to the sub 2% range that the Fed has been reporting, and even sub 1% that they use for cost of living adjustments for fixed income recipients. And then we've had others on saying, no, there's no inflation because all we've had is a bunch of currency creation, and that's like fuel for a fire, but there's no velocity of money, and therefore you can't call it inflation. Most recently, we spoke with Michael Pento, who is a money manager, and he talked about, well, we've seen a real bubble of everything in terms of equities and bonds and real estate. So a lot of that currency that's been created over the last decade is showing up in those places. So we'd like to get your perspective on, are we seeing inflation or not? And if so, how much, and how do you look at it?
Yeah, absolutely. So, it comes down to how you define inflation. And there are actually multiple definitions from different schools of economic thought. And so if you go kind of down to the foundation, some people define inflation as the increase in the broad money supply. And so by that definition, we have had inflation over the past year. It's about 25% year over year. And that's actually different from the past decade. So over the past decade, even though we had an increase in central bank balance sheets and things like that, that hasn't really translated too much to the broad money supply, which is defined as all the money in checking accounts, savings accounts, and currency in circulation. And so that's one of the broadest definitions of money. Last I checked, is something like $19 trillion for the United States. And of course, there's other ways to measure it, but that makes for a pretty good metric we can work from. But over the past year, due to the response to the pandemic and the recession, we've actually had the biggest year-over-year increase in the broad money supply since the 1940s. And so by that definition, have had inflation. And then the next question is, where does that show up, right? So if we have a 25% increase in the broad money supply, what prices are going up to justify that? Because we haven't had a 25% increase in production. We haven't had a 25% increase in the number of assets out there. And so if you have a 25% increase in the money supply, that makes something more expensive somewhere. And so for the most part, we've had it in asset prices. And if you go back further, we've actually had that over the past decade, even though we've not really had broad money supply increases. But particularly this year, after that, big downdraft in March when we had that big liquidity crisis, and then we had all of this stimulus come online, we have had a massive shoot up in asset prices. And so, for example, if you look at, say, Tesla stock, they've increased the number of cars they sold by something like 30%, but then their stock price is up like 800%. And so, it's not all fundamental driven. Same thing if you look at Apple stock, they've had an uptick in earnings, but then their stock basically doubled. And so you've had what we've mainly had is a valuation increase on some of those earnings. And you've seen it in real estate. But now consumer prices are a much more mixed bag. And so because you can broadly separate them into services and goods. And so, over the long term here, we've actually had a pretty significant inflation rate in services. And so healthcare services, education services, childcare services, things like that. And a lot of the reason is, people have really high, for example, healthcare costs. The United States has the highest per capita healthcare costs in the world by far. And so if you're paying someone to do something for you, you're basically paying for their cost of living, which includes things like their healthcare costs, their childcare costs, their education costs, things like that. However, if you're buying manufactured goods that are often made from robots or made from, emerging markets overseas, that is a deflationary force because all the technology and cheap labor can make them rather inexpensively. And so, for example, if you look at apparel in isolation, that's been roughly flat for decades because we've outsourced it, we've gotten better technology at it, and so we have a kind of, it depends on what basket you're looking at for inflation. And I think one of the key things to look at is commodities. And so if you look at most commodities, they're roughly at the same price they were 10, 15 years ago. And that's because commodities, of course, go through these big capex cycles, right? So sometimes they're scarce and we drive the price up, and that's a forcing function that makes them go out and find more commodities, bring them into production. And then, of course, they oversupply, and then we have this big kind of multi-year bear market where there's just too much commodities, and of course, their prices just stagnate for a long time. And so, because we've been in a period of commodity oversupply for the most part, we haven't had broad money supply increases go towards commodities, and that's kept some inflation levels down, especially for manufactured goods or things like that. And so I'd say that we've had targeted areas of inflation, mainly in asset prices, also in services, but not yet in a lot of manufactured goods, especially ones that are made by robots or overseas. And in order to get that broader level of inflation, you'd have to see, generally speaking, commodity and price increases. And of course, this year we have seen an uptick in, say, copper prices, lumber prices, just in the past several months because of the stimulus. And so the question is whether or not that's going to continue. And the one area that's still been kind of weak is oil and gas, because that's been the one that had the most oversupply because of all the unprofitable shale oil and things like that. And that, of course, is the largest commodity market, and therefore those prices have a big impact on everything else.
Yeah, I was going to mention, because we spoke with the Aden sisters, Pamela and Marianne Aden, they talked about upticks in both copper, and they mentioned in building materials, you mentioned soybeans, they also mentioned, and that's what a lot of people have been watching and been concerned about disruptions, COVID or not, related to the supply chain for food, and wondering whether we should be anticipating a big spike in food prices going forward. Do you have any visibility of that?
So there are people that cover that more specifically, but I have been watching the uptick in a lot of these agricultural prices. And so, I've been, using some fertilizer investments and other things like that to have some indirect exposure to that industry. But that is something to watch. If you do continue to see broad money supply go up, if there's anything that can impact the production of all those different agricultural products, then yes, it's pretty easy to get inflation. So if you don't have broad money supply increases, it's harder to get inflation in various prices. But when you're in an environment where money supply went up 25% year over year, and it's still going up, not at the same rate, but it's still going up in the low double digits percent wise over, say, the past 6 months, that is an environment where any sort of supply shock can easily lead to inflation.
We've got a question here. It's related to something you mentioned about the CPI that the Fed uses for their decision making. Menachem Saylor says, Lyn, do you think it's likely we'll see both increasing unemployment and CPI simultaneously within the next couple of years? What does the Fed do in that case?
Oh yeah, that would be stagflation. And so it would partially depend on a couple things. I think in this case, they would pick to basically boost unemployment rather than control inflation. And there's a couple of reasons for that. So if you look over the past century, we've had two, notably inflationary decades. And so those were the 1940s and the 1970s, and they were for two very different reasons. So the 1940s, we were end of the long-term debt cycle. And so actually, last time I talked to you, we talked about the difference between the short-term debt cycle and the long-term debt cycle, which is basically a major deleveraging event where there's usually some component of currency devaluation to basically inflate some of the debt away. And so if you look in the 1940s, the government was running massive deficits that were over 20% of GDP. The central bank was monetizing a lot of those deficits because there's not enough capacity to buy all those bonds, and so you got a rapid increase in broad money supply. And of course, you had some supply shocks along the way, especially because you're fighting a war, so you're getting every commodity, every ounce of production you can get. But what the Federal Reserve did was they kept interest rates low, so they kept them near zero, and they even capped the long end of the curve. And so if you look at 10-year Treasury yields, they were like a flat 2.5% the entire decade, but inflation spiked 3 times into the double digits. And that the main reason they had to do that was because federal debt was so high that the government would have an acute fiscal problem if they were to let interest rates price at their real rate. And so basically, the release valve had to be the currency and the bonds. If you were holding bonds or cash, you lost out on a real basis, even though you got all your money back nominally. And people that had their money in real estate or equities or commodities did well. Now, if you go forward to the 1970s, we're in a very different situation. So by then, due to a lot of that, that inflation and kind of deleveraging in that sense, federal debt was actually very low in the 70s as a percentage of GDP. And so when you had that inflation show up because we went off to the gold standard, we had oil supply shortages, Volcker was able to raise interest rates to contain inflation because debt across the private sector and the federal sector were both low. And so it wouldn't cause an insolvency crisis for him to basically choose to protect the currency. And that's what he did. And so if you fast forward to now, it looks a lot more like the 1940s. And we talked about before that the Fed officials are already talking about yield curve control as an option that's on the table. And so I think the model to watch is kind of the 1940s, where if they had to pick one, they would pick unemployment, and they would let inflation run hot for a while, and that of course has all manner of different kind of consequences down the road. But they would basically pick government solvency over the maintaining the purchasing power of the currency.
Right, and in fact, they have come out and said explicitly that they think that they need to have a target that's higher to compensate for the not meeting their inflation target in recent years. Can you talk to us about how you see that playing out going forward and how it impacts the ordinary individual?
Yeah, so I mean, basically the Federal Reserve only has a couple levers to pull, and so they can move interest rates and they can change asset purchases, and so the Federal Reserve is not good at creating inflation on their own. They are really good at stopping inflation if they want to, like what Paul Volcker did, or they can choose to let it run hot. The other areas where you can get inflation are either commodity shortages, or if the federal government just runs these absolutely massive deficits, and then the central bank, monetizes their treasury issuance, like we saw last year, for example. If you were to have that multiple years in a row. And so basically what the Federal Reserve is saying is we can't necessarily create inflation on our own, but we can step aside and let the fiscal authority create all the inflation they want, and we'll even help them by buying their bonds because no one else is going to buy that many bonds. And then instead of trying to cap it as soon as it's 2%, we intentionally want to let it run hot. And so that's basically their goal, is to have negative real yields for quite a while. And so anyone who holds cash in banks or holds treasuries over, say, a 5-year period is unlikely to maintain their purchasing power, even if they're going to get, they're going to get paid their interest. They're going to get, they're not going to lose on a nominal basis. It's just that the amount of purchasing power that those dollars have will decrease over time, most likely. So if you look back in the 40s and 70s, for example, let's use the 40s because that's kind of the closest example. You lost about a third of your purchasing power over the course of a decade if you were holding 10-year treasuries. And a little bit more if you were holding cash or T-bills. And so, again, you got everything back. It's just that what you got back you could buy less house, you could buy less copper, you could buy less silver, and things like that.
Yeah, that's we've had a couple of guests on where we've talked about that. That's sort of like I guess I'd call it a stealth or cowardly tax, where by debasing the currency, you can say you're keeping your commitments, you're still giving your Social Security beneficiaries their same payments or whatever, but it's just there's no guarantee what it's going to buy them, though. So
yeah, exactly.
To me, that's just immoral. We have a question related to this Brian Doyle says, is it even possible to see a stock market crash, which are liquidation events in this modern world, with the Fed being so active? And if so, is it possible that a stock market crash would actually push real assets higher at the same time, knowing that overvaluation of stocks and what the Fed will do in response? For example, a stock market crash, but Bitcoin, gold, and silver rallying simultaneously.
So it partially depends on the reason. So, if you look back in March of 2020, for example, when you had that liquidity shock, everything went down. Everything other than even the long end of the Treasury bond market. So even those sold off at the worst part of March. And the only things that really held their purchasing power were dollars or short-term Treasuries, things like that. So you saw stocks go down, gold go down, silver go down, copper, oil, Bitcoin, everything went down. And that's because there's a liquidity event. So you have all this kind of margin debt in the system. And basically just positions have to unwind pretty much at any price. And then of course you have a lot of dollar-denominated debt held by the foreign sector, and so if that dollar begins to spike and they have trouble getting dollars to service the debt, they have to sell Treasury reserves to get dollars, and of course that makes the Treasury market crash and go liquid, which is what we saw in March, and that the Federal Reserve freaked out about and literally had an emergency meeting on and basically had to bring out a liquidity bazooka. And so if you have a liquidity event like that, it's unlikely to have that big decoupling. So the question is, what happens, days later if you get that kind of liquidity boost? The Federal Reserve comes in, or the fiscal authority agrees to do another round of stimulus checks, whatever the case may be, and you get that pump up in assets. The question is, what assets come out of that a lot stronger than other ones? So if there are companies that have become insolvent, if they have too much debt, they are likely to come out of that in a crippled state. Whereas things like gold, silver, unlevered companies, things like that, they can come out of it much stronger, which is, of course, what we saw right after March. And so, for example, if you look at what bank stocks did after March versus what silver did after March, you had a very different kind of trajectory out of that liquidity hole. And so I wouldn't focus on specifically what happens during the liquidity crisis. It would be what happens immediately after it and then over the next, say, year or two.
Speaking of things that are real or not, this question from Donald Robinson says, if fiat currency backed by nothing is bad, then why are blockchain computer digits also backed by nothing considered desirable?
Well, part of it comes down to scarcity. And so, for example, if you look at Bitcoin, there's 21 million Bitcoins in existence. And basically, in order to change that number, there's no Federal Reserve chairman that can change it. There's no, there's no government that can just kind of create more. Instead, only if a majority of participants on the network agree. And basically, the majority of participants means that they're all, a big chunk of them are agreeing to debase their own investment. And so the way that's designed, it makes it extremely improbable for the amount of Bitcoins in existence to increase. And so what you have is essentially a deflationary asset, especially because some coins get lost. If you lose your private key, you never get the coin back. And so right now you have kind of a slow inflation until you kind of reach that 21 million, and then you're kind of deflationary on net. And so because you have a very wide network effect, right? So because you have so much hash power supporting that particular network, it makes it hard to you can't just have a fork and then that other those other coins kind of create the same value. It really comes down to the hash power, the security of that particular protocol makes that for scarcity. And so even though it's not a physical gold coin or something like that, there's still scarcity. Whereas fiat currencies are backed by nothing, but they also have no limit to the number that can be printed. And so literally a handful of individuals can get together and just decide to increase the broad money supply by 25% year over year, and all the participants that own that currency have no say in that. And that's the biggest difference between, say, something like a blockchain currency. Particularly, I'm not talking about the little altcoins, the long tail of thousands of crappy coins. I'm talking about the biggest one like Bitcoin that actually has the network effect, compared to an actual fiat currency.
And just so I make sure I'm understanding, and for the benefit of everyone else, when you talked about the network effect was the fact that there's so much activity, development, and interchange. There's a critical mass that forms, and Bitcoin is currently the leader of that. So it's less likely that you can say the argument has been given. You don't have to debase within the limited quantity of Bitcoin. You could just have any number of different variants or varieties or types or splits or whatever of it, and therefore that would create more quantity of the currency. And you're saying no, because it has this critical mass that's specifically around Bitcoin. That's why it's a fixed number.
Yeah, so we can separate it into two pieces. So one is the hash rate in particular, which is basically a measure of how much processing power and electricity is going into verifying transactions for that network. And so, for example, if you look at some of the really small coins, like say, Litecoin or one of the derivatives of Bitcoin, like Bitcoin Satoshi Vision, it's ticker BSV. If you were to try to do a 51% attack on that network, meaning you basically try to get a majority of processing power and take over the blockchain and basically change the blockchain to give yourself more coins, that'd be an outright attack on that network. That's actually pretty cheap to do for some of those small coins because you're not going up against a lot of processing power. So you can spend a few $1,000,000 and attack that network and potentially get millions of dollars in return. However, Bitcoin has by far the most hash power in the world. There's more electricity that Switzerland consumes, basically defending the Bitcoin network. Plus, there's also dedicated hardware that's often in short supply. And so to actually do an attack on the Bitcoin network is nearly impossible. You basically have to harness the power of a small country and direct it all at Bitcoin. And even then, there's safeguards that would likely make it fail. But that'd be the entry price for even trying. And so that's the hash power in particular. Basically gives you a security advantage over some of those smaller tokens. And then second of all, if you have that kind of hard fork where you have some of these derivative networks come off of Bitcoin, if you go back to the all the nodes on the Bitcoin network, so all those different computer programs that kind of process and identifies what is a Bitcoin, those other ones are incompatible with it, and so they don't get recognized as Bitcoins in the system because they're not meeting the definition of what a Bitcoin is. They're not on the Bitcoin blockchain, and so in a similar way that I could go and I can go to Wikipedia. I could literally download all of Wikipedia on a thumb drive. It's actually not that big in terms of gigabytes, and I could go and host it on my own little server. And the question is, will I get a billion, traffic like Wikipedia has, just because I have the same, I copied the content there? And the answer is no, because I don't have the network effect that Wikipedia has, which is, millions and millions of links pointing to Wikipedia, showing up at the top of Google search engines and things like that. I don't have the user base that keeps editing Wikipedia. I don't have the server capacity to be able to handle that traffic. And so just because I were to copy a small segment of what Wikipedia is, which is just literally, the text they have, I wouldn't be able to replicate the value of Wikipedia in a similar way that someone can't just replicate Bitcoin.
On that note, I have to take this opportunity because it fits with what you just said to remind people that if we were to lose our platform here on YouTube, how would you know to find us? Well, one place you could look is Rumble. We're also on Brighteon, but also make sure you go to libertyandfinance.com, put your name and email address over in the margin where you can sign up for our free newsletter. It comes out 3 times a week. You'll have Lyn, her descriptions of her videos, and all of our interviewees and all of their descriptions and any links that they provide, any resources. Make sure you stay in touch with us that way, because otherwise you won't be able to find us. We won't be able to reach out to you. So we have a follow-up question here. Speaking of different types of currencies, Wolfflow says, in what scenario would you suggest people consider moving heavily into cash, and what fiat currencies would you recommend in such an event?
Well, I mean, it depends on how long your time horizon is. And so, of course, there are long-term investors and there are traders. And so someone can have, a lot of people, people argue with each other about what's going to happen. And half the time it's because they have different timelines of what they're talking about. So someone's talking about the next 3 months, the other person's talking about the next 3 years. And so I think it's important to hold, kind of parallel ideas in your head about what you think is going to happen over 3 years versus what's going to happen in a quarter or two. And so, for example, right now, I actually think cash is not a bad position for, say, a 3-month period, just because we're still seeing lockdowns around the world. We've come very far, very fast with some of these assets, and so in that tactical sense, I don't view cash as a bad idea in the short term. So if you were to see some signs like we're seeing now, where say the Federal Reserve is actually despite that they're buying so many treasuries, there's actually so many treasuries being issued that they're not buying, that you're seeing an increase in yields on treasuries to some extent. And you're seeing a little bit of an uptick in the dollar compared to other currencies, and that's putting some downward pressure on some of these, risk assets like commodities or stocks and things like that. And so in that near-term sense, I like holding a non-zero cash position just to be able to kind of rebalance into things, anything that kind of gets sold out too far if you were to have these liquidity events. And so I think there's use for it. But basically, long term, there's not that much that would happen to make me want to go into an asset that's going up at that the amount of those assets is going up dramatically, and that they're paying interest rates that are below the prevailing inflation rate, regardless of how you measure it.
All right, and we've got this related question about how currency creation internationally could impact Business. Mark 8 Holmberg says, with all of the weird economic things going on with money printing, etc., I wonder if things from China, for example, electronics, become more expensive in the future in dollars. I just wonder, since in my business I buy a lot of things from China, and if they become the next superpower and the U.S. falls behind, will Chinese goods no longer be cheap?
Yeah, so we actually are already seeing that to some extent. And so China is no longer the low-cost producer that they were. But of course, it's a relative game. So it's still it's cheaper to produce in China than the United States. But then there are some other countries like Vietnam or Bangladesh, whatever the case may be, depending on the specific thing you're trying to produce, that are potentially cheaper than China. And so different countries have different kind of expertise. And so there are actually some industries that are basically too cheap for China to do. And so that, for example, textiles are one of the cheapest things. And so China is not the most competitive in the world in terms of textiles. And so they have kind of a sweet spot where they have a pretty skilled workforce, but they're still pretty cheap. And that's why they've been kind of a key manufacturing hub. Now, what China is trying to do now, there's actually something called the middle income trap. So if you have an emerging market that starts off really poor per capita, and then they over time they build their manufacturing base, they benefit from the fact that their cost of production is cheaper, and they start building wealth over time because they start developing a trade surplus. Basically, it's the China story over the past 30 years. And they get richer and richer and richer, but then the problem is they end up pricing themselves out of competition. And so they have to pivot at some point to being, a more balanced economy. They have to have internal consumption more that kind of balances their export power because they're no longer that low-cost producer. And so China is kind of in the process right now of navigating that change over time. And so they're still exporting a lot, but they're also focusing more on consuming more of what they're producing. And so I do think that Chinese goods are going to continue to get somewhat more expensive. But then, of course, the question is, does the quality keep up with it? So, if you look at Europe, for example, Europe and Japan, particularly Germany and Japan, they still are major exporters of physical goods compared to something like the United States. And that's because even though they're fairly expensive, they're known for higher quality goods. And so it's really about the quality to price ratio and what kind of sectors they emphasize. And so I do think that China will continue to probably move up the quality ladder as well as moving up the price ladder. And some of the cheapest places it goes to Southeast Asia and places like that kind of the absolute cheapest areas, potentially even Africa. The really cheap source of production can kind of move elsewhere.
We have a question here from, speaking of currency and how it can affect, how policy and currency can affect pricing and our lives going forward. Tim Sandman says, Lyn, do you think we have in the UK worse in terms of modern monetary theory and deficit spending than the USA, in particular with respect to any potential future inflation?
So it depends on a couple of things. So if you look at over the past year, for example, the UK increased their broad money supply at a slower percentage than the United States. So the United States and Canada were kind of the leaders last year in terms of how much their M2, their broad money supply, went up, whereas the Euro area, the UK, Japan, China, they all grew their money supply at a slower rate than the United States and Canada did. And so going forward, it partially depends on a couple of variables, and the biggest variable is how large of a fiscal deficit the government runs, and then what percentage of that is bought by the central bank, how much of that kind of sovereign bond issuance. And it doesn't have to be directly from the government. It can be on the secondary market. And so partially it's going to come down to just political decisions. I do think that the UK currency is one of the ones that has potential to weaken more than some of the others because they don't have that structural current account surplus like the Euro area does, like Japan does, and like China does.
I wanted to circle back, if we could, to a question that you had addressed earlier about the tools that the Fed has at its disposal. You mentioned interest rates and asset purchases. Jonathan Stringer says, in an interview with Jerome Powell this week, he stated, quote, if inflation were to move up in ways that were unwelcome, we have the tools for that. We will use them. No one should doubt that, unquote. I question at what level of inflation the Fed would begin to raise rates and how high they could really afford to, given the high levels of U.S. debt and dependency on cheap money.
Yeah, so it's partially going to come down to what happens in practice. And so one thing is that the Federal Reserve, a lot of what they say is focused on getting markets to react a certain way, rather than what they think is going to actually happen in practice. And so, for example, if you go back to Jay Powell in 2018, He said the classic thing like, quantitative tightening is on autopilot.
Yeah, watching paint dry, nothing to see.
Exactly.
Yeah.
And then, of course, the market freaked out, and then literally like days later, Powell's just like, "Oh, we're just kidding. We're gonna ease. We're gonna be data dependent. We're gonna do all this." And so, they're in a place now where, on some instances, they're trying to drawbone inflation up. They're trying to say because they want to have negative real yields because they want to basically inflate some of the debt away. They want to have that reflationary impulse in the economy, and so they're saying like, we're going to let inflation run hot. We're going to let it go over 2% for some time. We're going to do that average inflation targeting. And so they're trying to get it up. But at the same time, they're trying not to give the image of looking reckless and saying that there's absolutely no situation where we'd raise rates. And so, yeah, they're going to find themselves in a situation where if you do get that higher inflation, but you still have very high fiscal deficits and debt, you can't really raise rates without kind of causing an acute fiscal crisis for the U.S. Treasury. And so that'll be kind of a really interesting thing to navigate. And I have a feeling it's going to look more like the 1940s, where they basically say, we have to choose between hard options. In the 1940s, they said, well, we're going to win the war, and kind of the dollar is going to be the release valve for that. I think in the 2020s, you're going to have, well, I mean, we can't let the Treasury go insolvent, so the dollar is going to be the release valve for that. And I think this is something to watch. I remember, the late Volcker even said a few years ago in his later years that he wouldn't be able to do today what he did back, all those years ago, because he was aware now that the debt situation is so different that he doesn't really that same mechanism would be much harder to do today.
Wow. So I just want to make sure I got this. You were saying, like in the question previously, and now referencing again about cash, the role that cash will likely be impacted. People, you say, yeah, you need liquidity so you can take advantage of opportunities and things in cash. Short term, not a problem. But you're saying, based on the fact that there may be real difficulties with the dollar in the policy impacts on it going forward, people should not consider cash to be their long-term savings mechanism, for example.
Exactly. Yeah, I would consider it a medium of exchange and a liquidity buffer, but I would not consider it a store of value. And so things like gold, even a diverse collection of high quality, reasonably priced equities. For some people, Bitcoin, you can have a real estate. You can have a spectrum of different types of store of value. Even things like, anything that's scarce, fine art, classic cars, fine wine. There's, people all have their different things that they consider a store of value. But the thing that they have in common is some degree of scarcity. Whereas holding cash where their real yield is negative, it's only good for medium of exchange and liquidity management. Now, if you go, people often just focus on inflation, but that's always just one side of it. So if you look in the 80s after Volcker raised rates, we still had substantial inflation in the 80s. It's just that by then it was manageable, and more importantly, yields were above inflation. And so, for example, if say inflation is 3%. You're holding a treasury yield and that's paying you, say, a treasury bond, you're getting 6% a year. That's still a reasonable store of value because you're actually maintaining your purchasing power, assuming inflation is somewhat measured correctly in that system as it was more back then. But basically, if you have positive real yields in the sense, and it's actually kind of a real inflation, then that can still be a store of value. But in this environment where you're likely to have negative real yields and an increase in the money supply, if cash becomes a particularly bad store of value over the long term.
Yeah, that's what Rick Rule. We've asked him, and other broadcasters have asked him as well, how long he sees the gold bull market has in it, how many legs he thinks it has, and he says, as long as these conditions prevail that you just described, if you can't get a real yield, you need to, money will go where it's treated well. So
exactly.
Stephen McSweeney asks, what's the first metric you would watch for to say that we're 100% going to end in a hyperinflationary crack-up boom?
I think you'd have to see the floodgates open, right? So, we're kind of still in this phase where we don't exactly know what level of stimulus we're going to get over the next year, for example. We see, last I checked, the Biden plan was proposing something like 1.9 trillion, and then potentially larger infrastructure spending after that. Now, even though we do have a narrow control in the Senate for the Democrats, that is, it's a very narrow thing, right? So it's 50-50, and then you have the tiebreaker. But of course, you have some members that are not all Democrats, for example, are progressives. You have some that are in the center. You have some that are kind of on the border there. And of course, you then have some Republicans that can actually vote with the Democrats in some cases. And so you have that kind of that fragile majority, at least for the next 2 years. And so I think we'll have to see kind of what comes down the pike. I think you'd have to see kind of massive fiscal spending, and you could also see, for example, if the blue majority were to strengthen in 2022, you can then further increase the amount of fiscal spending that can happen. And so I would focus primarily on what's coming down in terms of fiscal deficits that would cause higher degrees of inflation. Now, my base case over the next, call it 10 to 15 years is not for outright hyperinflation like Weimar style, because hyperinflation usually has a couple, key characteristics that go into it. So one is you generally need destruction in your production base, right? So you generally need either you lost a war or you did some sort of social policies that kind of just radically changed how production's working. And if you have that, fall off in production, like something like Venezuela or Weimar Republic or Zimbabwe, that's where you can get a hyperinflationary event. Similarly, if you have, debts denominated in a currency that you can't print, like Argentina or Zimbabwe, all these countries like emerging markets that often have that problem, that's where you can get more of a hyperinflationary scenario. Now, if you have a developed economy that has an intact production base, you can get high levels of inflation, but it's pretty hard to get outright hyperinflation. Something you have to basically compound mistakes on more mistakes. You have to kind of have that inflationary event and then just utterly fail to control it and just keep compounding that. And so I don't currently consider hyperinflation my base case for developed markets. I'm looking more towards high inflation, and so that's kind of what I'm on the lookout for.
What do you consider high inflation, and how would that impact ordinary people in ways that means meaningful to them?
So that would depend. I mean, if you look back in the 40s, you had spikes into the double digits. So you had upwards of 15 to 20% inflation at some points. The 70s was a little bit lower in the absolute sense, but it was more sustained. So you saw kind of low double digit inflation reached. And so I wouldn't be surprised to see something like that, like high single digits, low double digits. You could have spikes that are much higher than that. But of course, it depends on what time frame you're looking at. Like I don't necessarily see that in the next 6 months, but as you go deeper into the 2020s, more is on the table, especially depending on what's coming down the fiscal pike. And then who you are, it partially depends. So, for example, if you look back in the 40s and the 70s, you actually had a somewhat of a decrease in wealth concentration, and that's because the people that have a lot of the cash and bonds, a lot of them are the ones that are hurt. And whereas people that, for example, are benefiting from fiscal spending and things like that, they're kind of treading water because they don't have a lot of cash that's being inflated away. They're also getting a lot of cash and they're kind of treading water. Similarly, if you have, say, a middle class person that has most of your net worth tied up in your house and you have a big fixed mortgage on it, and then you have inflation happen, so the house goes up in price and the fixed mortgage basically gets inflated away, that person ironically does very well. And so it's really going to depend on how people are positioned. So anyone who has a lot of assets, they can do well if they're mostly in scarce assets. But if they're in things like cash or treasuries, or for example, really highly valued, growth equities that are just not kind of, supporting their valuations, those are the areas that can be more impacted. Similarly, if you are on the lower end of the income spectrum, it's really going to depend on what sort of policies are driving inflation. So if you're someone who has a job and you're getting some sort of stimulus check and you're smart with the money you're getting, you can navigate that pretty well. Whereas people that are, say, priced out of the labor market, but then prices are going up, those people can have a really tough time. And so inflation is one of those things where it affects all these different elements of society very differently. So it's never a fun time for anyone. But who it impacts more or less really depends on how they're positioned with their assets or what their sources of income are. And so the best people can do is have a diverse set of assets, emphasizing scarcity, cash flows or things that can't be easily reproduced, and then also trying to have control of your own income streams, diversity of income streams, rather than say highly reliant on an income stream that you don't have a lot of control over.
Fascinating. We really appreciate the thoroughness that you give and the readiness that you give to answers to all these questions. People really are trying to understand the road ahead. There's so much in our world right now that is unknowable. People have so much uncertainty. They don't know what next week, next month, or this year is going to look like. And the thought process that you offer really gives a good basis for making an approach at understanding at least some possibilities of what's going to happen and some of the major factors and principles that are at play. So we just thank you for being here with us. If people want to follow your work more, where should they go?
I'm at LynAlden.com, so I have a lot of free articles and a newsletter. And I'm also on Twitter at Lyn Alden Contact.
Well, we just thank you, Lyn, for being here again on Liberty and Finance.
Yep, thanks for having me.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.